Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Carrying forward the part 2 of yesterday's video, where we had discussed 5 stock ideas as per Goldman Sachs recommendations. Now, Goldman Sachs had come out with top 10 investment stock ideas for 2025, 5 of which we covered in yesterday's video. Today, we will check the remaining 5. See, when anyone gives recommendations, it is absolutely necessary that we do our own research based on those recommendations. Recommendations are a direction in which we can look at when we take our investing decisions. But is that direction correct for us? Is an individual question. So, depending on our risk taking capacity, the amount of money that we want to invest, the duration for which this investment needs to happen, the decisions can change. So, following the directions that we receive from well known, world renowned investment bankers like Goldman Sachs, it is very necessary that we check these recommendations if they are a proper fit for us. Now, I have done my research based on the recommendations of Goldman Sachs, and that is what I'm going to present in today's video. So, we will start with the first stock for the second part of the video. Goldman Sachs has given a recommendation by recommendation for Mahindra and Mahindra in the auto sector. Now, Mahindra and Mahindra is a conglomerate with leadership in SUVs, tractors, and farm equipments. Its quarter three results for financial year 2025 showed revenue growth of nearly 9% with EBITDA margins at 10.7, while farm equipment revenue declined by nearly 2% due to decreased rural demands. Goldman Sachs suggests that the EV strategy implemented by Mahindra and Mahindra is gaining traction. The new launches that they brought in the EV segment, the XUV.E8 and the BE.05 models, have been successful. Goldman Sachs also projects that there will be a turnaround in the farm equipment segment post monsoon and will drive earnings growth to a CAGR of nearly 18% through financial year 2027. There are certain risks that we should be aware of, particularly in the supply chain disruption, especially in the semiconductor availability. This could impact production schedules, and additionally, increased competition in EV space from domestic as well as global players like Tesla poses a big challenge for M&M. Our take on Mahindra and Mahindra. Firstly, Tesla's announcement of entry in the Indian markets in 2026 possesses both threats and opportunities. Why? Because of increased competition in the premium EV segments, and it will also possess opportunities with enhanced focus on EV infrastructure like charging stations across the country. Secondly, M&M's heavy reliance on Chinese battery technology, its partnership with CATL, possesses great risk with the ongoing geopolitical tensions between India and China. But it has recently entered into a joint venture with Volkswagen for any MEB components, which mitigates this risk. Thirdly, companies' capital allocation strategy for investing in promising startups through Mahindra Rise has created hidden gems with its stake in Switch Mobility, now valued nearly at 4,600 crore rupees. On the tractor front, the PM Kisan Drone Yojana initiatives like these bring in opportunities for new product lines but also reduce demand for the traditional farm equipments. Also, we should be aware of a news that has come in only lately of Chinese BYD, the car that is giving tough competition to Tesla, setting up a plant in Hyderabad worth 85,000 crore rupees. So yes, the competition in the EV space is really going to heat up in India. The stock is currently valued at a PE ratio of 20, which appears reasonable. And given its leadership in the SUV and tractor space, it has a strong balance sheet with cash reserves of nearly 18,500 crore rupees. And the return on capital employed is also improving, currently standing at nearly 18.5%. So, what we think about this stock is that it is a good long term play which is worth accumulating at dips. With so many new entrants in the auto space, the auto ancillary segment is also worth watching for. Correct? Companies like Precall or Motherson Sunni or Minda are will have a good run in the long term with new entrants in the auto segment in the country. So those stocks should also be on our watch list. The next stock on the Goldman Sachs radar is the healthcare stock Apollo Hospital. Now, healthcare in India is world renowned for easy accessibility as well as cheap medical facilities that are available in the country. Unlike most of the developed Western nations where healthcare is out of reach of common man and not easily accessible to all, it is a different story in India. So, where health care tourism is on the rise, medical tourism is on the rise in the country, domestically as well, penetrating into the deeper pockets of the Indian geography is where the growth lies. Now, Apollo Hospitals is one of India's largest private sector healthcare networks, which runs over 72 hospitals, has over 4,400 plus pharmacies, and the Apollo 24/7 digital health platform. Its quarter three results were impressive, where revenue grew 11% year on year basis and EBITDA margins also improved at 23.2%. Goldman anticipates that the hospital occupancy rate will improve to 72% in financial year 2026, up from the current 68%. Also, the Apollo 24/7 digital platform is set to break even in 2026, accumulating more than 15 million active registered users. On the risk front, you should be aware of regulatory changes, especially procedures in the Ayushman Bharat scheme, which could affect margins. Recently, the government announced a standardized format for billing across medical establishments in the country. Now, this could result in operational hiccups and also put pressure on margins. Increased competition from corporate healthcare companies like Max and Manipal possesses increasing competition for Apollo Health. On the digital business front, the entry of Tata 1mg, the digital pharmacy, has increased competition and put pressure on the margins of all digital pharmacies, including Apollo, in the country. Our take on this, well, Apollo is integrating or rather diversifying from the traditional medical outlet or medical facilities to new improved versions in preventive care. Its Pro Health program, which combines preventive diagnostics with the help of AI, has enrolled nearly 1.8 million users, which creates a recurring revenue stream for the company. Secondly, the company's expansion in tier 2 cities with its asset light model. It gives O&M contracts, has improved capital efficiency, and has expanded the business of Apollo beyond like top tier cities. There are several challenges that we as investors should be aware of. The proposed National Medical Commission's fee regulations for medical education could impact Apollo Hospitals medical colleges' profitability. The talent war for specialist doctors is intensifying, with compensation inflation running at 12 to 15% annually. And the rapid expansion of Ayushman Bharat coverage under the government's universal healthcare push could put pricing pressures on corporate medical facilities. The stock's current valuation at 50 PE appears to be slightly expensive, but its healthcare ecosystem approach, combining physical and digital assets, justifies this premium. The next stock on the Goldman radar is Adani Ports. Now, Adani Ports is India's largest private port operator, handling over 400 MMT million metric tons of cargo annually across 15 ports, which represents 25% of the national port capacity. Now, its quarter three results showed a cargo volume growth of nearly 15% year on year basis and EBITDA margins at 64%. Goldman projects double digit volume growth by financial year 26-27 as the Winsham Court of Kerala becomes operational. It is set to compete Colombo in the transshipment facilities. The company's vertical integration into facilities like logistical parks and warehousing creates value chain synergies for its customers. Now, regulatory scrutiny of Adani Group following the 2023 Hindenburg research report allegations continues to affect the sentiments for Adani Group of companies. But Hindenburg has since closed shop, and many of the cases against Adani groups have closed. But global trade disruptions, geopolitical tensions across different geographies could impact the port business. Our take, well, Adani Port remains fundamentally strong despite group's controversies. Its recent acquisition of Gopalpur Port consolidate its position on the eastern coast of India. Now it creates a logistical efficiency corridor for Adani Ports. The company's shift towards automation and mechanization has helped it to maintain industry leadership position when it comes to EBITDA margins. But there are several factors which need not be ignored. Firstly, the company's huge gross debt of 48,000 crore rupees, although it is manageable as its net debt to EBITDA ratio stands at 2.1. It could face pressures if the interest rates remain elevated. But again, the business that Adani Port is in is not asset light, but it is capital intensive, so that factor cannot be taken out of the equation. Secondly, the group's concentrated promoter holding structure possesses governance issues. Thirdly, the capacity expansion of JNPA and Paradeep ports by government entities could increase competition. The current valuation of Adani ports with a PE of 14 appears reasonable when compared to global peers. But again, investors should be aware of the risks attached with the business. And those investors who believe in the India's trade infrastructure growth story, this is a good stock for long term investment for such investors. The next stock recommendation by Goldman Sachs is InterGlobe Aviation, IndiGo as we know it. Now, IndiGo dominates Indian skies with a market share of 60.2% as of February 2025. It has a fleet of more than 380 aircrafts flying to 118 destinations. The quarter three results of financial year 2025 showed a 17% year on year increase in passenger numbers. Goldman Sachs anticipates that the stock is set to benefit from the aircraft delivery schedule of 40 to 50 aircrafts annually through financial year 2027, which will help expand its domestic as well as international capacities. Goldman anticipates yield improvements as industry consolidation. The recent Air India Vistara merger reduces irrational pricings across the sectors. The risk that one should be aware of is the heavy cost or the volatility in the aviation turbine fuel, which comprises nearly 40% of the operations cost of airlines. So, any volatility in this fuel cost possesses a significant risk for airline companies. Additionally, aircraft delivery delays from both Airbus and Boeing can hamper the growth plans of companies like Indigo. Our take on Indigo? Well, Indigo is the king of cost savings in the Indian skies, right? But there are several factors that you need to be aware of. The Pratt and Whitney engines has affected 75 aircrafts in Indigo fleet. Now, if the problem persists longer, it can affect capacity and increase maintenance cost for the company. Secondly, the international expansion strategy, now nearly 30% of its capacity, faces stiff competition from Middle Eastern players like Emirates and Qatar, for particularly in connecting Indian passengers to Europe and North America. Thirdly, the company's yield per passenger could face pressure from Air India's revamped premium offerings, stealing high value business from IndiGo. Correct? But there are certain positive factors as well. The company has recently entered into code share agreements with Turkish Airlines, Virgin Atlantic, and Qatar Airways, which creates revenue synergies without capital expenditure. The company's strong balance sheet with 32,000 crores in free cash provides a significant buffer against industry downturns. The stock trades at EV to EBITDA of 7.5, which appears reasonable given its market leadership position. But again, investors should be aware of the risk in the aviation sector and the inherent loss making outlook that the aviation sector has long had. If you are a long term player and believe in the aviation sector story, then yes, this stock is for you. The last stock on the Goldman radar is Power Grid Corporation of India. Now, Power Grid is India's largest electricity transmission company. It operates more than 175,000 circuit kilometers of transmission lines. Now, electrification is going to be a decadal play with AI models and chip manufacturing being highly energy intensive. The need and requirement of electrification and energy is going to be at an all time high in this decade. The company's quarter 3 result showed a revenue growth of 6.5% year on year basis and PAT increasing by 3.2% to 3,780 crore rupees. Now, Goldman highlights significant capex opportunities linked to India's renewable energy integration, with Power Grid Corporation expected to invest nearly 25,000 crores annually through financial year 2027. The company's role in developing the National Green Energy Corridor strengthens its long term growth visibility. The risks that one should be aware of when it comes to power grid is the regulatory changes in return ratios allowed by Central Electricity Regulatory Commission, which could impact margins. Additionally, project commissioning delays could also possess risk for the company. Our take on Power Grid Corporation, well, the business fundamentals warrant closer examination in the light of India's energy transition. First, the government's ambitious target of 500 gigawatts of renewable energy by 2030 necessitates massive transmission infrastructure upgrades, with Power Grid positioned as the primary beneficiary. Secondly, the company's diversification into smart metering through its subsidiary PFCCL creates new revenue streams. It recently won bids for installing 10 million smart meters across 3 states. Thirdly, Power Grid's telecom infrastructure subsidiary, PGCIL Telecom, is capitalizing on data center boom by leasing dark fiber to hyperscalers, generating non-regulated income. But there are several risks that we as investors should be aware of. Increased competition from private sector players like Adani Transmission and Sterlite Power in the project bidding process. The amendments to the Electricity Act can increase competition. One cannot ignore a huge receivable figure of 52,000 crore rupees that possesses a significant risk for power grid. These are the receivables from financially stressed state electricity companies. Now, the stock dividend yield stands at 4.5%, which provides a downside protection. PE ratio of 9 is attractive when you compare it with global energy transmission companies. If you believe in the India electrification story, the need for electrification in the coming decade, which is being talked about by founders of Nvidia to AI platform founders, all are talking about the greater need for electrification and energy requirements. If you believe in this play, then yes, Power Grid is the stock for you, which is worth investing. So these were the 10 stock recommendations by Goldman Sachs. As I have already told you, let me reiterate, this will give you a direction in which to look out for investing. But the research is going to be your own. If you are convinced that a particular stock is good enough, if you are convinced and believe in the business plan of the company and its future, then please invest your money in it. This video was for educational purposes and a research driven video on the basis of my understanding and my risk taking capacities. What is your take on these stocks? Let me know in the comment section. I would like to hear from you. Until next time, stay safe and happy investing. And before you go, don't forget to like, subscribe to my channel for more such informative content. Until next time, goodbye.